Let's stick with the markets now and bring in Kristina Hooper. She is Chief Global Market Strategist at Invesco. Happy Friday to you, Kristina. Do you see a particular reason why stocks are giving back some of their recent gains today? Any particular catalysts out there for you?
I think there are concerns that the Biden administration is not going to be able to get the $1.9 trillion stimulus package that they so desperately want. They might have to have a slimmed down version. It's not to say that there won't be some kind of stimulus. It's just not going to be as much as they'd like, or at least that's what the fear is.
So if that does indeed come to pass, where we get a stimulus package, but it's not as big as Wall Street had initially been banking on, does that change your portfolio allocations in any way, Kristina? And what are clients saying about that?
No, it doesn't. Our expectation is that we are going to see an economic recovery this year. And the biggest catalyst driving that recovery is, of course, wide distribution of vaccines. So fiscal stimulus is much lower on the list. I would also argue that there's the potential for tranches of fiscal stimulus. I think that's what the Biden administration is hoping for, that it can continue to provide morsels of stimulus until the economy is able to return to a more normal state. So there's always the potential to keep things moving along. But I think the key is, of course, that wide distribution of vaccines.
You know, speaking of stimulus, you've got the Federal Reserve, and they're meeting next week. They've certainly thrown a lot at this pandemic. Do you expect any market-moving news to come out of Jay Powell and company?
I think it's unlikely. Keep in mind that what we've heard from Jay Powell and other Fed officials for a long time now is a beating of the drum on the need for fiscal stimulus. They have an administration now that is proposing a significant fiscal stimulus package. So if we're going to hear anything from them, it's likely going to be a continuation of that message that what the market really needs, what the economy really needs is fiscal stimulus. I would say, though, of course, the Fed will likely reiterate its commitment to remaining very accommodative.
Right, which should be certainly dovish for the markets. I want to get back to another catalyst for the market, and that is earnings. Next week's going to be a big one. We're going to hear from a lot of the big tech companies, including Facebook, Apple, Tesla. So far, earnings have been pretty good, right? I mean, they've been beating estimates. The bar, you might say, it has been lowered, but they've been beating those estimates. What are your expectations, and particularly for those big tech names?
So I would expect we're going to continue this theme of better than expected earnings. I think companies have done a very good job managing expectations and then coming in and meeting or even bettering them. And so I don't think there's going to be any change to that with earnings this coming week. And I would expect that technology will continue to perform well, given that investors need a hedge. Yes, there's this excitement, this rotation towards cyclicals, but technology is an important component of a portfolio just because it's shown some defensive qualities as of late.
Do you think, though, that investors should take pause, given the fact that we know the Biden administration has made pretty clear regulation could be coming down the pike for some of these big tech names?
Well, certainly I think that is a concern, but it is probably lower down on the list in terms of concerns. I think perhaps the greatest concern for investors this year is going to be the nature of COVID-19. How quickly we'll be able to stop this pandemic. And of course, part of that is these new strains that have come out that are more contagious and seem to be less able to be stopped by current vaccines. Of course, there are a lot of question marks around that, but to me, that's going to be a much bigger concern as investors consider whether or not to have exposure to tech or to increase that exposure.
And Kristina, I know that when you look at economic recoveries, I mean, the last one that we have to really look at for any kind of comparison is after the Great Recession of 2008 and 9. How might you compare the economic recovery we're hoping to get out of this pandemic to the recovery we saw after the Great Recession?
Well, I think this recovery is going to be more robust and more inclusive. Keep in mind that last recovery was billed as a jobless recovery, and truly employment lagged the overall economic recovery. I think that's going to be very different this time around because of the nature of this crisis and the fact that once we get that vaccine broadly distributed, as Dr. Fauci has said, the economy can return to some level of normalcy, which should mean that service jobs come back, that really the economy experiences that strong rebound that we've all been hoping for.
Before we let you go, want to touch on the bond market and the rise we've been seeing in the yield on the 10-year Treasury. How much further upside is there for that yield? And when is it going to start impacting the stock market? I mean, does the equity market have a tolerance for a higher yield on the 10-year?
Well, I think so long as the economy is headed in the right direction, so long as we have that broad distribution of vaccines and the economy is recovering, that investors can tolerate, that stocks can tolerate higher yields. But a lot is dependent upon how quickly yields go up. I wouldn't be surprised if we see yields get up to 1.3, 1.4% by the end of this year. But again, as long as there's a healthy economic recovery underway and it doesn't occur abruptly, which is often what can rattle stock market investors, then I think that it can be well tolerated.
All right, Kristina Hooper, Chief Global Market Strategist at Invesco. Thanks so much and have a great weekend.
Thank you. You too.